Want my latest market insights? My latest report, Catching This Falling Knife of Metal Madness, is now available. Scan this QR code or click on the link in the description.
Samantha, we had you on the show I think it's about 3 or 4 months ago, and I really enjoyed the interview. You gave us a good 10,000 foot view of the gold and silver markets. You was talking about the broader equities, and today is a fantastic day to discuss these things again, because right now everything's red. The whole of the market's going down. I can't see anything that's up today. And gold and silver are just coming off some interim peaks, and you pretty much called that, so we'll definitely get into it. But before we really dig deep into these specific subjects, just what's your take on what's going on right now, Samantha? Is this just regular volatility, or could there be something underlying this that's more significant?
When we actually spoke last was in early October. And at the time I had, continued my bullish thesis on trend long precious metals and industrial metals. But I warned of metal volatility, specifically calling this kind of funding stress from the metal volatility would seep into a higher dollar. And we did have equity volatility, but for short duration. This time was very different. And I actually put that out there. It's not about the rising dollar, although I was expecting a bounce, and it was perfectly timed with Kevin Warsh's announcement. But it was not Kevin Warsh's announcement as Fed chair by Trump that caused this turbulence in the metal market. Absolutely not. So, I detailed all of this very, very straightforwardly in a January 22nd post saying I'm looking for an event that's going to trigger the top. It actually was the options market in large part, and this silver ramp that just got way, way, way ahead of its skis. And it did have a very nicely timed top. When we were talking on the 21st, 22nd, I wrote up my long thesis about I'm looking to time the top. And it was lucky or good. I run a live trading room every day. So I caught it live. I had already posted my thesis that it was going to be coming in February. So I had a very firm and high conviction that we were going to have metal volatility in February. But then it was literally live on that 28th, 29th, both days pre-market. I said, nope, we cannot wait until February. You must protect now. So I did time it this time as well, because I had already done all of the work to research from my intermarket as well as the fundamentals, supply and demand. And I had laid all of this out in a very long thesis client post, particularly as it related to the options market. And I explained that the options market is like a fire. It needs oxygen to maintain this elevated implied volatility, and it is expanding, which is helping, obviously, the price, where focus is more on the fundamentals. My focus was on we are extremely an outlier as it relates to optionality, skew, and this fire, if it does not have oxygen, it will start to burn out. And that creates this volatility as well. And they were talking, of course, in silver, gold, paper markets, but also XAG and XAU USD. So the gold and silver focus had all kinds of reasons for this top to kind of burst. And we did have a 39% pullback, peak to trough in those 2 days. And then I updated my call, which is, wait, this is a falling knife. We need to stabilize here. So that's exactly where I'm at. I've got actually some lower levels for gold and silver to retreat. And I think once we get there, we'll start to kind of digest. But in a nutshell, we've hit investor confidence hard. So I'm not talking about the diehard trend long folks, right, in precious metals that are hedging against all kinds of really, really important reasons, or the fact that China and other countries are settling trade outside of the U.S. dollar, U.S. treasuries, and petrodollar as a continuation theme. This is not going to stop central bank accumulation, retail hoarding, and that doesn't go away. The macro backdrop doesn't go away. But silver in particular is a commodity. It's not a reserve asset, so it needs to be treated differently. Anyway, long story short, the combination of the metal volatility, the crypto volatility would seep into equity volatility. That was my bet. That was what I posted. And we did have that. And then we've had follow through because of software. So when you say nothing is up, that's not true. We actually have had an immensely powerful value rotation. It started in November. Eyes on the prize. That's my focus, is sector rotation, market direction, stock selection. But this sector rotation has been outsized. So out of growth into value, large cap value, inflationary assets in particular, And this has really continued. We had lots of green on the screen while the software was imploding, software stocks, crypto, and metal volatility all were front and center. So I think there's actually reasons for each of these to be in distribution. And the software is very much AI focused, worried about who will survive and who can thrive. And they're pricing out a lot of obsolescence right now. They're worried about software companies, SaaS, that won't be able to compete because of the advancements that have been moving very quickly in the software space. We could talk about that. Separate from metal volatility space, silver resembled kind of a 1973 peak. And sure enough, we got that lovely, 39% pullback of size. And I think equity volatility is a different beast because all of this combined, crypto losses, metal volatility, now software volatility, is just hurting investor confidence. And it's going to be a while before we can actually catch our breath and have reason to go long again.
Wow, that was a great synopsis, Samantha. I'd love to get into multiple parts of this, but let's just pause for a second on the silver and gold volatility. One of the things that I think a lot of retail investors have been confused by, and I think you're the perfect person to explain this to them. I think you already did, but maybe you could just kind of go through it in another way to maybe make it simpler, is they're going to see the physical shops, they're going to buy coins, they're buying online, and there's shortages everywhere. People are out of inventory, and there's been record physical buying in numerous places. Europe had record buying, I think, going into January at certain locations. I think the UK did, the Royal Mint. So there's definitely a lot of physical being purchased. So people are saying, well, why is the price turned around? We're seeing one thing in the physical market, and now we've got this big crash. So as somebody that's actually trading and looking at the option skew, how do you explain that to just the everyday man and woman on the street, Samantha?
This is different. It depends on where you're also located. For example, in China, 95% home ownership and wages that are increasing, it has translated into a lot of Chinese citizens buying with their savings, I should say, collecting tons and tons of appreciation in their gold and silver holdings that makes them wealthier. So they actually have a really good incentive. They already have their homes, they have higher wages, and now they're saving in gold. We also have this central bank continuation of again, this is a testimony of the lack of faith in U.S. political stability, of course, geopolitical risk, of course, trade settlement outside of the dollar, treasuries, and oil. Yes, it continues. None of that has changed. None of those macro backdrops have changed. But timing a top when the FOMO comes in and expands this parabola, it creates this condition of trapped longs. Parabolas are not shorts. They are trapped longs, and they're typically the last in, first out trapped longs. So we're not talking about physical holders. We're talking about this supply deficit for silver as a commodity, the hoarding by central banks as a monetary reserve asset. They're separate. We have to not treat them the same. But metal volatility hits hard to the entire space. And so then I have to go through and I'm like, silver still has more to go, but gold is better. Gold is going to be less volatile, even though it fell 16% peak to trough over those 2 days. It wasn't uneventful, but it wasn't 39%, right? And none of the trends or the macro trends have changed. But when I'm, very, very, very focused on this getting out of play, in other words, it's no longer stable trend long. It's too parabolic. It will always, every time, every parabola will trigger volatility from trapped longs that also produces liquidation events. Now, it doesn't mean that it's not going to get accumulated a little bit later, right, after it calms down. And you can talk about all the, the gyrations and mechanics of the banks and the the spread differential, west from east, etc. But that's not what's driving the demand. The demand is they see crypto isn't performing. In fact, it's failing, right? Crypto isn't, by the way, in my humble opinion, even a digital gold. It's a disappointment. You know how I feel about Bitcoin and crypto. So I'm not surprised that it's falling. And in fact, it is the worst debasement trade proxy. Gold and metals are. There's no question. So I think the analysis that I can do underneath looking at the option market and the FOMO is one that's more intermarket and technical and sentiment that I now look for a rug pull. Any excuse is going to come in and interrupt this bullish flow. And that's all we needed. We needed just a little bit of a trigger. And anyway, this is why I look at investor sentiment when it's overdone. And we've had examples in silver where this has happened before, very much 1973, right? And this is one of the things that I gave as an example. This silver mania, and by the way, we all look at the market and we have justification of why we like something, whether it's a stock or a sector, because the market doesn't like boring. It likes manias, right? We went from AI, to the space theme, to data centers and space theme, to Bitcoin has had its time of mania. Silver had its time of mania, but this is still investor psychology or behavior 101. Parabolas are trapped longs, and then they reset after investor confidence resets. And right now the market is just too shaky and unstable. There's no reason for shorter or intermediate buyers. They don't need to go in and chase this falling knife. So I personally am more of an active analyst, and I'm not just looking at many, many years in the future and putting blinders on to any volatility that occurs. I actually look at this silver mania and I wonder to myself, wait a minute, how low is this going to go? Because my price targets hit on the upside. They have pulled back, but have not pulled back to my targets on the downside. And then when I look at the supply deficit specifically that everyone's getting so excited about for silver, there's a story there. They're talking about how we need 135, dollars an ounce for solar break even. Okay, that's not necessarily so true. And one of the examples that I gave is Longai, which is a major Chinese manufacturer. They actually have started to migrate away from silver to copper. Why? Because high price is the cure for high price. So now everyone's getting excited about copper. I've been very bullish on copper for a few years. We made it to a $6 a pound. I think that can double over time. So it all depends on timeframes. Everyone has their different or their unique definition of time frame. But I think that was one of the reasons why we were also going to come back down for silver was the arguments about data center build out. Some of it is demand BS. Also solar substitutes like copper. This whole nuclear renaissance and U.S. government as venture capitalists throwing tons of money and price floors at critical minerals. Well, we got to come down and meet that price floor, and then they might even lower it. So it's not something that can be sustainable when you have a ton of FOMO in a particular market. I don't care if it's equities and AI or metals or Bitcoin or space or data centers. It runs up and then they actually get a case of vertigo and they look down and then we go down. Any narrative prick in that bubble absolutely creates the volatility, and the volatility does not stay isolated to that particular asset. It spreads, it bleeds. Software will bleed to hardware. Metal volatility bleeding to Bitcoin and crypto volatility or equity volatility. It's all related.
Yeah, that was a great summary of how it's working, because that's what I think people need to understand is there is a huge difference between owning a physical metal because you're interested in this macro thesis, you believe that there's going to be a reset, you believe the dollar's going to be dethroned and that we're going to go back to some kind of gold settlement at the international level, so central banks will keep buying and wealthy families will keep hoarding. So yeah, there's a huge narrative there, and that narrative can go on for decades, and it has been. I think anyone that's been watching the gold space since 2000 property values have collapsed versus gold. The Dow to gold ratios in single digits now. It was 44 in in the year 1999, just before the 2000 .com crash. So we are seeing everything really devalue versus gold in the long term. But in the short term, with so much financialization, yeah, you've got a load of traders out there. And if they're caught on the wrong end of something, they're going to be loading into shorts to try and cover the longs. And you've got all kinds of volatility that comes from that. And I was trying to tell my audience that in the 1970s, when we had the best decade for gold and silver, it was the most volatile decade also in terms of single day declines. We had I think it was the top 10 single biggest declines were all in the 1970s. Maybe one of them wasn't, but I think it's 9 or 10. So knowing that, you should expect these big drops as well. Like these are things that are going to happen even if we are rising going into 2030. And I really liked what you titled your article, which was Catching the Falling Knife of Metal Madness. That was a good one. But sometimes people get angry at these articles because they don't want to hear that things do go down. But I'm just always trying to reset expectations that no, volatility to the downside is going to happen, even if you believe in metals. And I certainly do. So, okay, let's move on to the next part, which is your article, The New Yen Monetization Framework. I absolutely loved this because nobody has discussed this. I've not seen anybody else talking about, we've all discussed the yen carry trade, we've discussed gold, but you've put these two together into a cohesive narrative. So I'm going to hand it over to you, Samantha. Please tell us what that means, the new yen monetization framework.
Well, this was actually in response to what happened on January 24th. And there was this rumor that Fed Treasury, US, did a rate check, quote unquote, rate check on the dollar yen. And immediately that excitement that they would basically intervene and buy the yen, support the yen. And I immediately came out with that article. I said, absolutely not. Basent will absolutely not intervene and buy the yen. This is going to reverse. And by the way, by reverse, it wasn't just the dollar yen gyration would actually reverse because it would prove to be a rumor, not fact, but also that the dollar would get bid. And that was very important to stalking my metal short. Right. And I said that on the 24th. This is one of the events, a rising dollar that can, interrupt this bullish flow within the metal space. And again, this is separate from a trend time frame. I'm talking, timing the turns to better protect. That's how I've gotten clients who are still very long, but they still want to protect on a 39% drawdown in silver or 16% in gold. This is just what I do. So the other part of this was the new Japanese PM. So she came in at and got elected at the same time that gold and silver volatility really started moving higher and the yen lower. That was very important. If you put you don't have to do a fractal, but basically if you put a chart side by side of the dollar yen or the JGB, the Japanese government bond yield, next to gold, and the dollar yuan next to silver, you will see a tight correlation. Very, very tight correlation. And what I noted, in fact, I was discussing with you on the 21st when you asked me when I was available for an interview, I said, this volatility in metals is going to come in by their snap election in Japan February 8th. And then all of this rotation right now of FOMO into the metals before the Lunar New Year, where the markets shut down in China, is oxygen getting sucked out of the metal FOMO trade. This is very dangerous to longs. So when we were talking, we couldn't get this interview in time before this fall on the 28th and 29th, but that was exactly what I was stalking. So basically, yen carry trade is very unnerving for U.S. equity holders because it is always met with selling in NDX. So NASDAQ sells off, yen gets a bounce. We had a sizable one back in July of 2024. We had nothing for 2025. I didn't see anything for 2025, and I said it early. And then in this article that I also posted, I said, first of all, this drop in the dollar yen that looks so dramatic on the 24th, it's going to revert because Basent will not intervene in the yen market, period. Second of all, this is something that they will hike, but not, I'm talking about the Bank of Japan, but not for probably 6 to 9 months. The bigger worry of a yen carry trade will be toward the end of the year. But in the meantime, it's not the same play. So this yen fear is overblown. It was overblown in 2025, and I track this every single day. It's overblown now. It will be on my radar again as we get closer to the end of the year. But in a nutshell, they're in a coordinated role with the U.S. as it relates to dollar swaps and treasury holdings. And there is friction. There's no question. There's risk. No question. Money goes home when equities fall. Treasuries and dollar all together create this cocktail, this brew that then triggers a dollar yen unwind. But I'm not as worried about that unless we were to get falling yields, U.S. yields, 10-year, falling oil. Then we can see yen carry trade triggers start to come into view. But right now we have the opposite backdrop. We have very sticky yields. We have oil that's actually popping a little bit because, of course, Iran escalation, and that is a really big risk. And we have to talk about that because that is another reason why people hold precious metals, right? This is a real risk. So I'm trying to say this without any excitement here, but we do have a very different backdrop of political risk, very different. And it's not the bunker bombing of, July of last year, June of last year, where it was theater. And we knew it, and the market knew it, and the market went higher on this de-escalation between Israel and Iran. Okay? Metals didn't go crazy during that time. They went crazy when the new PM came in of Japan. That's September to October through November, December, hot fire flames, right? They were settling. Even Japanese citizens are converting from yen to gold, right? The Chinese are converting also their savings into gold. We have a very strong trend underneath the surface. But as it related to this, outsized move that we had in the yen, I thought it would get reverted. It did. As it relates to this pullback. And gold and silver, we dumped. But this escalation that's now coming up for Trump and Iran, I think has legs. And so I am not going to say short metals here. And it's not because of revaluation. I don't believe that's a thing that we have to worry about for a few years. But I absolutely think there is heightened risk of escalation in Iran, not theater like we had last time. So I'm actually careful about the metal trade because I'm not recommending short. I do think silver was over its skis. In other words, at 20, it's a good buy. At 120, it's absolutely not a good buy. It's just not. Now, you also know my price targets for higher in gold and silver. 6,000. I gave that early, right, last year. And I have reasons for it. Like I documented why I can see 6,000. This is part of my gold will outperform the SPX in 2026. So I can still see 6,000. I don't want it to go to 10,000, honestly. I think that's bad news for the US. But the point is, I think I can see it moving higher. And silver on an overshoot of fear and FOMO, we could definitely get to that 150. But I don't think it's as much from the the supply shortage question, as many, many, many are excited and say it's going to 300, 500, what have you. I'm a little bit more suspect on that. And those are reasons that I, kind of put through. And it wasn't just in the silver market SLV, but it was also in this 1973 parallel where silver volatility is a mania and then it resets and the investor confidence is shot. And we also have more on the macro side that kind of also unwinds some of that trade. But for gold, I think it's going to be pretty durable long and for a long time.
Yeah, I definitely agree. Just whilst we're on the subject of oil, Samantha, a lot of people have been really surprised at how they've managed to keep the prices low. It's seemingly being immovable with all of the different shocks and threats, especially in 2025. We never really got a massive spike up. But yeah, I can't see it going any other way if there is a conflict with Iran, then up. And that could, in and of itself, cause a lot of problems. So do you just have any more comments on that, Samantha, with the oil price?
I am very non-consensus, and I would say the opposite. So let me explain. So we do not have rising global oil demand. We have falling global oil demand. There's a reason why oil price has fallen, and it's a really, really good one. So I'm on the other side of this, where I had called this move higher in March of 2021 on an inflationary proxy. Oil and energy would be the inflation proxy that hedge funds and others would manifest their trade, and it was strongly correlated. Oil yields inflation, right? Oil yields inflation. They rise together. That's the proxy we all chase in economics and macro, funds. So once we had the top with the buy the rumor, sell the news, for lack of a better word, Russian invasion of Ukraine in March of 2022, and we have been falling ever since. It wasn't really until about 2023, 2024 that I realized not only is oil completely bifurcated from yields now, yields can continue higher on term premium, etc. I'm very bullish yields. I'm bullish inflation entrenched, not saying we don't get a deflation impulse from time to time, but I'm talking about at the core, we have an inflation that is entrenched and moving higher, full stop. That's also why metals are a very good trade to offset that debasement, right, of a falling dollar. But this is different for oil. I came out and I said, nope. I absolutely firmly believe that we are going to have oil, this was back in 2024 in April, that we're going to have oil fall into the 60 to 40 handle for crude, WTIC, by the end of 2025. And we had oil fall into 54. So close enough. So the point is, I'm very bearish oil, the price of oil. The difference now that we have Trump in is that we could actually create not only and we have had escalation with oil. It shoots up and then it's a short the rip. So it's event driven, geopolitical. A drone hits a refinery or an oil rig or what have you, and it's immediate spike and dump. Iran escalation back in June of last year, it was a spike and dump. So ultimately, underneath, I'm a very big bear, and I have been for 2 years. And I've been right about this. And people have disagreed with me. No, we have falling global oil demand. Why? China set out on a mandate of forcing folks to buy EV and electrification of everything. You've seen the solar farms, and the grid, expansion. Their electricity usage has been up and to the right, very, very strong. Their fossil fuel usage has been absolutely falling. So their mandate, their policy, they can do this, right? It's harder for us. But the point is, they dictated, you will buy, we want 50% of ground transportation to be in EV, electric vehicles, by the year 2030. They achieved that last year. So they were way ahead of it. Now we've got maybe 25% in Europe. Maybe more is coming into India with EV uses, EV use in ground transportation. This is something that a colleague of mine, Jeffrey Fouvet, has been early and right about as it relates to the grid, electrification, EV, solar, the whole 9 yards. So basically, I had a pair trade, long solar and short oil last year. And I don't see any reason to change that other than geopolitical escalation that creates a spike higher we short into. So I am very much not consensus, but I'm convicted in this call that this is not a backdrop where we can trade oil as an inflation hedge. Nope. Oil is not correlated tightly with rising 10-year yields. Not anymore. So they have bifurcated. And I think oil actually is just a short the rip. I don't think it's being suppressed. I do believe that Trump, of course, wants to make sure that at the pump, it's low. We have all kinds of other inflation, food, energy costs to heat our homes, etc. Insurance, it's ridiculous how much more we pay for things that is being, a story we're told. But as it relates to the oil at the pump, he has no reason to make it higher. And yet, I think we could get into conflict and isolation where he does start doing export controls. So the lack of ability to sell into Europe, Japan, etc., could become a threat in the future. That's something to also consider. Regional pricing, because already we've seen countries. This is very important. China's buying elsewhere and converting to EV. Falling global oil demand is actually a policy that triggers economic stimulus for a lot of families. India, we already know what's going on with Brazil. Can you rent an internal combustion engine if you go there? No, you live there. But I mean, they're just not commonplace now. In the US, we only have about a 10% adoption, and it's this mostly status symbol of Tesla. We're kind of on our high horse, and people don't trust so much because the administration hasn't allowed insurance to come in and support that market, still trying to kind of backstop the oil and gas industry, which is suffering. They don't want to go, he doesn't want to be responsible for another oil industry recession like we had in 2014 through 2016, where many companies went bankrupt or had to reemerge from bankruptcy. And crude dropped from, 100 to 20. So the point is, we have a threshold where we are absolutely, by organic nature of EV adoption and electrification, going lower in oil demand, but price hasn't been allowed to fall. So you and I disagree on this. I think price hasn't been allowed to fall. He doesn't want to get it too hot, too cold, trying to hold on to an industry that, unfortunately, is already in recession. So I think the oil and gas industry, as itself, is still the entrenched companies are fine. In other words, the entrenched means asset rich, industrial, infrastructure, heavy, can't be replaced. You can't just go and build all these industrial processes and plants and facilities. You just at the same cost that they were built. Labor is higher, right? The materials, raw input is higher. Oh my goodness. So I think they're going to do fine. I'm not worried so much about the majors and such within the energy space, the companies themselves. But as it relates to price, I think that we have a current upswing because of geopolitical risk, but we have a structural downswing because of falling global oil demand.
Well, that's going to be bad news to people who are piling in on oil stocks right now, Samantha, because that's
No, not right now. Right now, it's a great time to pile in on oil stocks because, like I said, they're entrenched, asset-rich, industrial, and their large cap value. I love, this has been a major theme, getting out of growth. And it was November 26th. I'm like, this is it. We're rotating into large value out of tech. And it's been in play for all of December, January, and here we are, February. The only stocks that were green yesterday were large cap value. So we have this entrenched asset base that is of industrialization that is not easy to replace. So I'm just saying we have a lot of hits right now that are coming in the oil industry, in the software industry. They're totally unrelated. I mean, the one common factor might be Trump, but the point is we've got AI as a structural change. We have falling oil global demand as a structural change. And what's he really going to be able to do about it? It's not about taco anymore. Even if he comes out in April in the US-China summit and he completely says, I was just kidding, let's go back to the way it was, right? What are the chances, really? What are the chances that that's going to happen? And still, is it going to change the structural tectonic shift that's happening in AI as it relates to software companies needing to decide Are we going to be able to survive or thrive? And investors trying to figure that out with them. And then, of course, same thing with the oil and gas space. So I know why people hold out in metals. There's no question about it. I just don't think that the FOMO that people get so excited about is it is should be you should not be complacent. When you see a parabola, know that it will trigger volatility, and those trapped longs will liquidate, especially short or intermediate traders.
Yeah, and I think you've got to be careful as well with any leverage plays on these things because the miners are extremely volatile. They are going to move double, triple what silver does. And they're all cyclical stocks as well. So if you buy at the right time, they can be fantastic. You get that volatility on the upswing and you can see the cycle go up. And these individual stocks in the last silver bull run just going into January were up 450%. Some of these stocks, 350%. On the downside, yeah, they can fall 80, 90%. I've seen it happen many times. So it's really about timing. And that's where I think somebody like you is really useful because the long-term thesis, people can listen to someone like me and they can hear about these ideas that I put out there. But in the short term, if you are going to be buying miners, if you are going to be buying oil stocks, you do need to have that short-term predictive capacity. And that's the harder bit because you can confuse the long-term one with the short-term one. And it's not always the case as we're finding out. And sadly, I do know a lot of people were piling into miners just last week with the FOMO. And
exactly.
Yeah, you could easily see yourself down 50, 60% in a month. And that's going to be hard because now you've got to get up another 120% just to break even. And yeah, that's not where you want to be.
But I think a lot of people right now who are hurting are from the crypto mania, from the metal volatility of late, and from the software crash that also is unnerving to those who have a very strong understanding of tech, but the old tech, not the disruption from AI. And I know that, silver exploded higher, but a confidence in future delivery imploded, right? So we had this perfect storm of why folks were piling in to silver. The physical inventory was eroding and they got very, very nervous. But as I mentioned, there's a lot of sentiment that also gets built into stocks. And if you have a, nice and 45-degree angle up and to the right, boring but profitable miner, there's no reason to get out. I'm still very bullish on miners, but I'm very bullish on, it's also very kind of classical or traditional finance, the more entrenched and established miners. I'm not looking for the explorers and the juniors that don't have funding, that don't, have not just funding, but also fines. I want the stuff that's absolutely there and they're already built out. The inflationary costs of building out right now and the cost of funding right now is ridiculous. So betting on that wildcat type of experience isn't me. So I'm still going to recommend strongly those inflationary, asset-rich, entrenched boomer stocks, whether they're in mining, whether they're in energy, whether they're in, a true industrial renaissance is in our U.S. economy. They're not easy to replace. I still think that's going to be our theme for 2026, and metals are going to be part of that.
Good. Yeah, I agree. Yeah, I've totally been focused on the same space. I think there's really good value in fertilizer companies. Like you said, the oil companies, although I'm on the fence about that, I think maybe there's better value in the midstream companies for oil because they've got longer term contracts because I just don't know what's going to happen with oil. I'm surprised that we haven't seen shocks yet. But like you said, some of these narratives are dodgy to say the least. And Trump can turn these markets around on a tweet and make a lot of money on it too, Samantha. So yeah, there's a lot of questions. But do you have any idea on the just overall backdrop? Do you think that there is the risk of something more systemic this year, or that the markets are going to be able to survive maybe a downturn in jobs, a jobs recession, or economic slowdown? Or is there actually a risk that we're going to see something more broad-based in which everything's going down together?
Yeah. Well, right now, I think we have front and center lots of volatility from crypto to metal to software, and that is dampening. There's no question about it. And that's also risk. But a top, as you you saw my title, right? Tops are a process, bottoms are an event for equities. It's the exact opposite for metals. Metals, you have bottoms are a process and tops are an event. So right now we have a topping process as it relates to equities. We've really gone nowhere fast since September. Now, are there risks? Iran escalation? Absolutely. And that's not something, that Trump can control. The Epstein file reveal fallout of Trump as lame duck president. This is something we're all waiting with bated breath to see if anyone, has the chutzpah to follow through and do the right thing. But there are risks for sure with AI, but not hyperbolic risks of, tons and tons of joblessness. That's a huge probability, but we don't have, um, it's not tradable right now. Corporations are still making money, right? And the biggest of them, some are negative free cash flow like Amazon because they're investing so much into their AI infrastructure. They just announced a layoff of 30,000 people. That's not because they're doing poorly. That's because they're funding AI infrastructure for the future. So we have a massive bifurcation, right, of the Mag 7 and or the large cap tech growth plays taking a chill pill while software gets annihilated because of the fears of which ones actually will survive and thrive. There is right now this whole investor, come to Jesus moment of, okay, where am I really going to see a monetization? You can't just talk about it for 2 years. You now have to produce monetization. And we need to know that you're going to be okay to stick around. And investors do exactly what they do best. They sell first and ask questions later, but only when the narrative dents their thesis. And then you can see the forced selling. That's what's going on right now in software. That's what happened with the metals trade when silver got too hot. And that's what will happen with equities as well. And I think that is something Trump can't fix. Trump cannot taco his way out of an AI structural evolution that is revolutionizing how software is deemed and how deemed as a profitable safe haven. It's no longer a hedge fund hotel. Not at all. And I can show example after example of seemingly perfectly fine trends in software that are down 60%. We're talking huge, not just the Microsoft, but also ones that you might not know about that are down because of their exposure to AI rewriting the rules of future revenue. And investors don't know how to price that in. So yeah, that's a huge risk. I'll tell you what the benefits are though. On the flip side, if software investors calm down, right, and metal volatility and crypto volatility, if all that calms down, and we don't enter a war, that's a big if, then we could actually look again at the fact that we do have large corporate issuance, large corporate earnings growth. We have stock buybacks, which are supportive. Easy money, Fed, easing is still a fait accompli, regardless of who comes in. As long as we don't have a recession, this is obviously a deflationary impulse. And right now, labor market, although we don't have a lot of data because it keeps getting hidden, but we do have some stabilization underneath the surface with the economy, if we can believe the numbers. And we do have a very incentivized White House, right? Trump does not want the market to fall apart, especially with midterms coming. So this is an incentive. We got to look at motivations here. This is an incentive for him to do what is necessary along with Treasury, along with Fed. And for the most part, we've really ridden the waves of his strategy of chaos, right? We've ridden these waves. Every single weekend, we've had a tape bomb and we have endured. The big difference wasn't the crypto crash that was going to come. That it's in its winter as of October, in my humble opinion, when I posted that. And the metal volatility was going to shake out, the short or intermediate term players who FOMO'd this silver mania. It's a mania, right? We prefer manias over boring. And they're basically going to have to lick their wounds and figure out when and if they want to go back in. Huge margin increases, by the way, too. Lots of funny business between, under the surface. We're not going to talk about that. But the point is, that is what investor confidence has to repair, and then they can reposition. But this equity market, we could have a falling dollar as long as it's slow. We could still have the debasement trade of size, and I still see this as a strong possibility, where the dollar falls slowly. Keyword is slowly. And guess what? Inflation assets appear taller, right? So it isn't just the metals trade. It's not just the value of a house or a car, but equities. So even though we're going through a lot of volatility right now on target, and we're probably going to do this until April, May, and we get Fed Chair Powell, who is supposed to be, stepping down on May 15th, and a new Fed chair coming in. There also might be turbulence around that whole runway because of criminal charges against Powell, and Senator Tillis coming in and saying Powell's not leaving until these charges are resolved. So we have, folks actually saying this is not okay. We need to figure this out first before we just fast pass Kevin Warsh. So I think we have a lot of turbulence between now and May. That has been my baseline bet. I thought it would pick up a little bit more in February, as you know, from my client post. And then I had to pull it forward January 28th. I said, nope, you got to protect now. So now is here. I'm waiting for this drama to base and investors' confidence to return, and figuring out what's going to happen with the next mania, because there will be one. There's always mania over boring when it comes to equity markets.
That's true. That's one thing that never changes. And, sometimes that's the most instructive part of analysis, is just looking out for those signs that there's a lot of FOMO and a lot of mania. If somebody's calling you up, asking you about something, and they've never been interested at all, that's usually a sign that, there's, everyday crowd is getting in at that point. And that's usually the last person to get in before we see things roll over. And I did notice that going into the last few weeks, that the purchases of physical silver, a lot of them were first-time purchases. There was people hearing about this silver. Oh, silver's going up. I want silver now. And I thought, well.
Bingo.
Yeah, that's maybe the time to start. Well, like you said, Samantha, there's nothing wrong with taking profits. There's nothing wrong with de-risking your position. It's a smart thing to do in a volatile market when the overall risk is, who knows how big the risk is now. There's a lot of opaque parts of this system, whether it's private credit or, equity valuations. There's a lot of issues, systemic issues. So it's always good to take money off the table during these times. And I think that's smart. And then long term, you can make your long term bets in physical metals for sure. I certainly think that's a smart thing to do. But when it comes to miners and leveraged positions, no. I like to take my profits and I sleep better at night, Samantha, when I don't have an asset up 250% with 100% of my stake still in it. That's a risky scenario.
And there's also that 1973 parallel, forgive the pun, but we had a problem in 73 to 74, which is something I mentioned in my client post when I was stalking a silver top, right? So I said, we got a mega silver bubble meets mega gold bull market. And notice the difference also in that heading. Silver's a bubble, gold is a bull market. So I felt very strongly that 1973-74 is a period of time. It's not just a one and done. We just had a violent reset in a very short period of time, right? But bigger picture, the problem when the US dollar also weakens too much, when the Fed cuts, which we're kind of looking like is going to be a replay, it forces the Fed to tighten later on. So inflation starts picking up again. Precious metals will be that inflationary proxy. And back in 1973, the equity rally started to falter. It faded with the dollar. Remember our tariff terrors back in February, April, where the equity market fell with the dollar? Same thing. And then we got more aggressive selling of foreign held equities and treasuries and dollar. And so that's the risk, is when we come back into this with exuberance again. 1973 had a lot of dollar selling with equities, and then gold and silver dropped 45-50% as well. So once we get a hint, this is what I'm getting to a point. And we're not there right now. We're just seeing volatility in metals. once we get to a point where inflation starts to pick up speed stateside again, and the Fed just intonates. I'm not even talking about hikes, but intonates that they're going to hike. Whew, bad news will be very bad news. And it won't have to do with oil. Metals are right now the new oil as it relates to an inflationary proxy. But you'll have a period of spiking gold and silver and then another crash of gold and silver. It'll be the same where metals are a collateral trade and they will fall with the S&P. They will fall with equities. This is later. We're not talking Fed hikes, are we? So I'm saying be on the radar, because the problem won't be just metal volatility. It will be seen as a pull forward of credit stress. And that's when we can get a deflation impulse. And you know that gold and silver do not do well in a deflationary environment. So that's all I wanted to kind of set up as you're looking ahead, because you are longer term. Once we get any whiff of Fed hikes, be careful. That's the next time to really protect.
Just one more question, Samantha, before we leave, because I'd love to get your take on this. In 2008, we saw, obviously, everything go down together. At the end of the year, silver was the worst performing asset that year. It was, I think it was around 65% decline. Gold was the best performing because it was up around 25%. It crashed, but it still finished up around 4%. Maybe treasuries did better, I'm not sure. But it was, besides treasuries, which have a fixed yield, gold was the best performing asset in the GFC. Obviously, the normal dynamic in a crash is people start to rush to safety, and that would have been US treasuries in the past. Do you think that next time we have that similar scenario where we have a major systemic event, that treasuries are bypassed and sovereign debt's bypassed, and it's actually, we're going to see the rotation straight into gold, that we could see a different dynamic play out, or do you think it would play out the same?
Oh, it's definitely going to be different. Every time is a little bit different. And we have fiscal dominance right now, not monetary dominance, which is we really, really do have a very different backdrop as it relates to the value of the dollar. We get a sell-off typically in past, right? Dollar has risen as that risk off. Gold also rises and then falls because it's collateral. But the point, because it's used as a collateral trade. But in this particular backdrop, I think we have a bigger risk, which is that stagflationary backdrop, where prices continue to rise with yields, but growth contracts and we get that deflationary impulse. So it all, for me, is very focused on what dollar and yields does in this backdrop of credit stress. And when we have falling global credit demand, falling global oil demand, you're going to see, obviously, kind of a knee-jerk reaction for sure into the safe haven of a global reserve asset, which gold is number one. Silver is but a commodity. It will be treated as a deflationary impulse. This is a repeat. In other words, this is a continued mantra of mine. Gold is a reserve asset, not silver. It's a commodity. So try and separate them. Oil is not an inflationary proxy with yields. They're bifurcated. We've gotten into a whole new regime of fiscal dominance from monetary. So all those old economic fractals don't work anymore. So that's why I was mentioning the difference is profound, because we can actually have spiking higher prices in an economic slowdown, higher yields, which is very, very inflationary, in which case gold is still going to hold really firm, but demand for silver as a commodity could actually fall. Does that make sense?
Absolutely, yeah. Makes total sense. In fact, I'm more pessimistic than you for sure, because I'm calling it an inflationary depression. You called it just stagflation, so I'm taking it a step further. But I do think that's where this ultimately ends up, is a case of how long is a piece of string, because they can keep this dance going for longer than most of us imagine. So along the way, you've got to try and earn money and try and keep up with the inflation. And yeah, gold and silver's been fantastic on that front. But I think you've laid out for listeners why there is reasons to be a little bit cautious in the short term. And yeah, I think you did a great job. So thank you for your time, Samantha.
Thank you so much. And I enjoy this. We're kind of catching up since the October bent because a lot has happened.
Well,
Okay,
I'll just tell listeners I'm a huge
ahead.
fan of your Substack, so that's where I find your content, and you really help
Thank you.
guide my short-term thinking because I am
Yes,
a macro
I'm
thinker.
sure.
So I prefer to look at the big picture, but you are trading, so you give me lots of insights. So yeah, can listeners find you on Substack, or is there anywhere better to go?
Oh my gosh, yes. I run a financial research firm. I have a team of 10. Oh my God, from classical economics to futures day traders. I mean, we're sharing our analysis and trades for members from hedge fund managers to, folk teachers and farmers. So, I mean, I really have a very robust offering at LeducTrading.com, which is everybody and everything. Substack is my very focused macro kind of infused and sector rotation site where I post just my analysis, not my team. So there aren't portfolios and that kind of stuff. You still have to go to Leduc Trading for the whole enchilada. But as it relates to Substack, yes, at Samantha Leduc is where I have my the warning about the metal volatility coming into play and the dollar bounce and the yen framework. So these types of conversations that we're having, I've written about first, and that's in my Substack at Samantha Leduc, and also Twitter, X, whatever you call it. You can find me there at Samantha Leduc.
Awesome. Thank you so much for your time, Samantha, and I look forward to the next one.
Cheers.